Welcome to the UK Mortgage Market Insights for the week ending Friday, the 10th of July 2026. I hope you're all well. We do this every single week, same time, same place. So if you're new here, do stick around and please do hit subscribe because it genuinely does help the channel to grow. So this week's a proper busy one, and I really do mean that. We've had a whole run of lenders repricing, one going up, but most coming down. We've had swap rates actually ticking up rather than down, which sounds like it shouldn't make sense given the lender cuts that we've seen, but I'll walk you through why it does. We've also had house prices creeping back into positive territory, which is nice to see for a change. And then we've got a couple of bigger stories rumbling away in the background. The Middle East ceasefire wobbling again and UK gilt yields climbing. And both of these matter more for your mortgage than you might think, especially if you're weighing up a tracker mortgage at the moment. So stick with me and we'll get through all of it. Right, let's start with lenders because there's a fair bit to get through this week. So Coventry Building Society started the week by increasing some rates, which is interesting in itself. Virgin Money, on the other hand, have cut fixed rates on both purchase and remortgage. Nationwide have trimmed rates by up to 0.19%. BM Solutions, who are the buy-to-let arm of the Halifax, have cut by up to 0.15 across their range. Halifax themselves have also cut by up to 0.15, and they've brought in some loyalty products for Lloyds banking customers who hold a Premier account. So that's worth flagging to any of you clients that are Lloyds bank customers. Kensington have made a decent move too, up to 0.4% off some rates. Bank of Ireland have reduced rates as well. Accord have made some very light cuts on their buy-to-let range, but nothing too dramatic here. And Barclays have gone fairly big also, with up to 0.39 off purchase and remortgage rates. Leeds Building Society have trimmed selected rates, and Atom Bank have reduced rates on their prime mortgage range too. To finish off the week, Coventry then reduced a selection of mortgage rates. So, when you add all that up, that's 8 or 9 lenders moving the same way, and just the one having a little bit of a wobble. And that tells you something, doesn't it? Coventry clearly think that their pricing had got a touch too competitive and they were pulling back a little, which I can actually vouch for, while pretty much everyone else is still out there fighting for business. So it's not quite a full-blown price war, but it's edging pretty close to one. Now here's the bit that might actually surprise you a little. Swap rates, which is essentially what lenders price their fixed rate deals against, have gone up this week rather than down. So 2-year swaps last week were sitting at 3.92 and they're now at 4. 5-year swaps have moved up even more, from 4 to 4.16. So you might be thinking, well, hang on, why are lenders still cutting if the cost of money has just gone up? And it's mostly because these reprices were already in motion before this week's swap movement. Lenders don't tend to flip their pricing overnight every time the market twitches a little bit. But if swap rates keep climbing from here, I wouldn't be surprised to see some of this week's cuts get quietly reversed within a week or two. And just to give you a bit of perspective on this, because I think it's easy to lose sight of what has happened. A year ago, 2-year swaps were sitting at 3.605 and 5-year swaps were sitting at 3.671. You can see that if you zoom in on the swap rate chart that's up on the screen. Now, a year ago, we were talking about how rates were improving and everything was looking rosy. Of course, with caveats that rates don't always decrease. And this is a prime example of that. Money is still more expensive than it was this time last year. And that's just the reality of where we are. Now, I was quoted in The Sun on this exact point this week, so let's talk about it, because it's something I've seen plenty of people do in the 25 years that I've been a mortgage broker. The temptation, especially when lenders are cutting rates like they are this week, is to hold off. Wait for absolute rock bottom price before committing to anything. And I get why nobody wants to lock in today and then watch the rate drop further next week. But waiting for the perfect moment isn't really a strategy. It's more of a gamble. Because nobody rings a bell when it hits rock bottom. You only know you've missed rock bottom once it's already gone. And we've actually got a real example of this from earlier in the year. Back in January, the average 2-year fixed rate was sitting around 4.83%. Then the Iran war broke out at the end of February. Lenders pulled something like 500 products off the shelves almost overnight, and by the end of March, that same average rate had jumped to 5.75. On a £200,000 mortgage over 25 years, that's the difference between paying around £1,149 a month and £1,258 a month. So roughly an extra £1,300 a year for anyone who'd been sat there waiting for a slightly better deal. So the sensible approach, and this is what I say to anybody watching this, is that you can actually lock in a deal normally up to 6 months before your current one ends, and if rates do fall further in the meantime, most lenders will let you switch to a cheaper option before the completion anyway. So there's very little downside to securing something now rather than gambling on a better number turning up later. On criteria changes, there's been nothing major to report this week really, beyond what I've already mentioned with Halifax's loyalty range for Lloyds Premier customers, so a fairly quiet week on that front. So moving on to the wider economic picture, house prices are looking a bit more cheerful, which is good news. The Lloyds House Price Index, which was released this week, and that's the new name for what used to be the Halifax's index by the way, it's the same data, just a new badge on it, showed prices up 0.2% in June, bouncing back from a 0.2% fall in May. The average property is now worth just over $299,000, and annual growth has ticked up to 0.6%. Northern Ireland, as we keep reporting, is still miles ahead of absolutely everybody with 7.4% annual growth. So if you're watching this in Belfast, well done, carry on doing whatever you're doing. And for first-time buyers specifically, annual growth actually ticked up to 0.8% from 0.3% the month before. So there's genuine, if fairly modest, life coming back into the market. Now the two stories that matter more than most people tend to realise, the ceasefire in the Middle East looked to be holding for a while there, but this week it's wobbled quite badly with reports of renewed strikes and the American president himself coming out saying he thinks it's over. Oil's jumped back above $80 a barrel off the back of that, and at the same time UK gilt yields have pushed up to their highest level since June, with traders now pricing in a genuine chance of a Bank of England rate hike rather than a cut. Gilts and swap rates move together more or less, so that's exactly why we saw swaps tick up this week rather than down. And look, if you're one of the people currently weighing up a tracker mortgage, and I know plenty of you are given how competitive some tracker pricing has looked recently, along with a lot of the comments that I get on my videos, this is exactly the sort of thing that you need to factor into that decision. A tracker moves directly with the base rate, so if the market's now pricing in a real possibility of a hike rather than a cut, that's not just a bit of background noise. That's actually central to whether a tracker makes sense for you right now versus locking into a fix. So it's worth talking that through properly rather than just picking up on a headline price alone. Now, for the record, I'm not convinced that the Bank of England will hike rates because the economy is just too weak. But the trader pricing shows that there is a genuine concern and that nobody truly knows what lay ahead. But here's a question for you. If you've got a fixed rate ending in the next 6 months, are you keeping an eye on any of this? Or are you just waiting for the letter to land from your lender? Because by the time that letter turns up, some of the best pricing might already be gone. Let me know in the comments what you're actually looking at doing. Now, funnily enough, this time of year, we'd usually expect things to go a bit quiet. Summer holidays, school's out, everyone's off to Spain or Cornwall or wherever you go on your holidays, and traditionally that's when the market takes its foot off the gas a little. But it hasn't really felt like that this year. If anything, it feels like it's picking up rather than slowing down. Better weather's brought more people out to viewings, there's a bit more energy about generally, and we're certainly not seeing the usual summer lull in the office. So I'm curious, and genuinely curious, if you're watching this and you're either buying, selling or thinking about it, has your summer actually changed your plans at all? Are you pushing on now, or are you holding off until after the holidays? Pop it in the comments because I'd love to know what everyone's doing, what everybody's plans are. Now, one more thing before I wrap up. You'll have seen Lloyds pushing their £5,000 deposit mortgage for first-time buyers, and the advertising around it goes right back to their old 1996 campaign. The one with the couple getting the keys to their first home.
It's 1996, and you just bought your first home with a 5k deposit. Well, that's making a comeback. The Lloyds 5k house deposit, last seen in 1996.
Now, this is a clever move on their part if you think about it, and it's worth understanding why they're leaning on that particular era. So back in 1996, the average UK house price was around £53,000 according to the Nationwide House Price Index. Today, it's somewhere around £275,000 to £280,000. Lenders back then were typically working on multiples of about 3 to 3.5 times your income, nothing like the 4, 5, 6 or even 7 that we see as common today. Deposits were smaller too. First-time buyers were often putting down around 10%, whereas now people are trying to save over 20% just to get better interest rates. And buyers were younger on average, closer to their late 20s compared to the low 30s across the market today. Now, I'll flag that some of these specific figures are estimates rather than official statistics, because the detailed data from that era just isn't all digitised and so it's not easy to access. But the general direction of travel isn't really in question. Basically, it's getting more expensive. So when a lender pitches a £5,000 deposit product wrapped up in nostalgia for 1996, what they're really doing is highlighting just how much harder deposits have become to save, which is precisely the barrier their product is designed to get around. So it's really smart marketing. Now, I threw that in there just because I think it's worth you knowing what's actually being sold to you underneath the whole marketing. Okay, right, so look, let's bring this all together then. What does this actually mean for you? If you're a borrower with a deal ending soon, get your remortgage sorted early. Rates are still moving in your favour on the whole, but this week's swap rate rise is a decent reminder that that window won't stay open forever. Lock something in now, and you can usually switch again before completion if something better comes along in the meantime. If you're buying, this remains very much a buyer's market, and I really do mean that. It's not just a throwaway line that I'm using. We are genuinely busy at the moment because people are actively negotiating real discounts on asking prices. We're not talking 2 or 3% here, these are proper conversations that are actually landing. And the better weather's helped too. Funnily enough, more viewings, more activity, more confidence generally floating about. It does feel like the market's waking up a bit, even with summer supposedly slowing things down. Which is exactly why we built our in-depth property report service. So when one of our clients is looking at property, we pull together everything. The EPZ position, the sold history, the flood risk, the planning and the extension potential, crime data, broadband coverage, the lot. All colour-coded so you can see at a glance what needs following up on. And critically, it feeds into a 3-stage offer strategy. So an opening position, a negotiation position, and a ceiling. All backed by the actual data on that specific property rather than just a gut feeling. It's proving genuinely useful for clients right now because in a market where prices are up for discussion, walking in with real numbers behind you changes the whole conversation. So my view on all of this for what it's worth. Bank of England rate hikes are still unlikely because the underlying economy simply isn't strong enough to support that right now. But if cuts is the way it's going to go, it's going to be slow, data dependent, and with this Middle East situation flaring up again, probably slower than we'd all like. So don't expect fireworks. Expect a gradual grind in the right direction with the odd bump like this week thrown in to keep things unpredictable. So who benefits most right now? Well, buyers with a bit of patience and a broker willing to push on price. That's probably top of the list. First-time buyers too, where growth is actually outpacing the wider market at the moment. And anyone remortgaging who moves before their existing deal expires rather than waiting for that letter. So that's your lot for this week then. If you found this useful, please do give it a like, and if you haven't already, please do subscribe. And I'll see you next Friday. Enjoy the England game tomorrow night. Come on England, it's coming home, and let's hope that we get through to the semi-finals. In the meantime, take care.